But first, good and bad news from the Bank of Canada today and its decision to raise the benchmark rate a quarter point to 1%. The good news is for travelers as the dollar has soared. The bad news is for anyone carrying debt. The bank said the surprisingly strong economy justified the rate hike. Wages are rising and consumer spending has improved. The loonie jumped over 82 cents on the U.S. on the news. Well, let's take a closer look with the Conference Board of Canada's chief economist, Craig Alexander. He joins us from Toronto. All right, Craig, second quarter point bump in 4 months. Is this kind of a necessary evil when the economy is booming like this?
Well, 2 years ago, the Bank of Canada cut interest rates by 0.5 percentage point in response to the tumble in oil prices and other commodities that was going to weaken the Canadian economy. What we've seen over the last 2 years is a gradual adjustment, and in recent months, we've actually seen the Canadian economy delivering strong economic growth. And so the adjustment to the low commodity prices has taken place, and this warrants the Bank of Canada returning the overnight rate at least to where it was prior to the oil shock.
All right, so is this the second hike of many, or do you expect the rate to sort of flatline for a while?
Well, markets are currently putting about a 50% probability on an October rate hike, but I think I think that the bank's more likely to move to the sidelines. In their commentary, the Bank of Canada did highlight the rise in the Canadian dollar, which will, as we go forward, constrain or reduce the export competitiveness for Canadian businesses. And at the same time, they did highlight sensitivity to the rise of household debt that we've had in recent years. And I think that was a really important component in the communique, because I think what it basically says is that they're going to take a very gradual approach to moving interest rates higher. So having lifted rates 0.5 point, I think they'll pause for the rest of the year. But I would expect rates to continue to rise next year. I think we'll probably see 0.75 percentage point rise in rates in 2018.
Wow. All right. So let's take this down to street level. I was reading a shocking statistic that said the average Toronto detached house has fallen $400K in about 4 months. Is this going to accelerate the correction, and what might impact be on mortgage rates?
So variable mortgage rates will move up almost immediately with the rise in the overnight rate. In fact, we've already had the banks in Canada announcing increases in their prime lending rates. So I think variable mortgage rates will move up. Fixed mortgage rates will move up, but probably by less than what the Bank of Canada has hiked, because it will the rise in mortgage rates, fixed mortgage rates, tends to move in line with bond yields. So the increase will be a little less on that front. You know, when you think about household finances, credit card interest rates aren't going to change at all. So not all consumer finances are going to be impacted. This will, on the margin, add to the cooling that we're seeing in the Greater Golden Horseshoe area. You know, the market is still coming to terms with the regulatory actions that the Ontario government took, and this will add to the weakening effect. One of the things we did see, though, in BC was when they brought in the non-resident buying tax, similar to what Ontario did, it basically cooled the market for about 6 months, and then once the market came to terms with it, it then came roaring back to life. I think that the GTA and the broader Golden Horseshoe was on the same path. This will now add to that leaning against high house prices and imbalances on household debt. So at the end of the day, I do think it's actually constructive. I think the level of interest rates are still incredibly low. It is still cheap to borrow. People are still going to be able to find a 5-year fixed mortgage rate close to 3%, which is incredibly low. But I do think moving rates up a little bit is actually healthy for our economy.
All right. For those who have Florida real estate, at least until Irma's finished with it, but if they have real estate in Florida, what's the loonie going to do? Is it going to continue to strengthen it beyond 82 cents? Is this going to impact that in any meaningful way over the longer term?
So financial markets were expecting the Bank of Canada to raise rates, but they were expecting the bank to raise in October. And so today was a bit of a surprise to markets, and that's one of the reasons why you saw the Canadian dollar jump. Now markets are putting a 50% chance on a rate hike in October. If the bank does validate that and does pull the trigger, then the Canadian dollar probably is going to move a little higher again, because markets will start looking for the next hike. I think it's more likely the Bank of Canada will go on pause for October, November, December, and that would mean the upside to the Canadian dollar from the interest rate front will be more limited. And I think the Canadian dollar probably should be around the 80, 82 cent range.
Okay. One thing that I found kind of interesting, the Conference Board did put out a report today, and it showed the impact of carbon taxation on the economy. It looks like about a $3 billion hit on GDP next year. Where does that hit, and will consumers feel it?
Well, the cost of $3 billion from the point of view of introducing carbon pricing across this country, the headline sounds bad because $3 billion sounds like a lot of money. But when you're talking about a $1.5 trillion economy, you're really talking about a small adjustment. So will there be a cost from introducing carbon pricing and gradually raising it over time by $10 a year? As currently planned under the Pan-Canadian framework? The answer is yeah, there is a negative cost to the economy as a whole, but it's very small, and the economy can adjust to it. I think one of the things that really struck me working on this report is that carbon pricing only gets us part of the way towards where we want to go from hitting our Paris Accord agreements. Much more of the emissions reduction needs to come from switching towards more green energy sources, switching away from fossil fuel generated energy, and also from new technologies and changes in lifestyles. So in point of fact, what the report looks at is the feasibility of achieving the government's targets. The answer is we can get there and the economy can manage it, but it's going to require some very large investments and some big shifts in terms of sources of energy.
Okay. Craig, I'm almost out of time, but I got to ask you one quick question, if I could, on these liberal tax changes they're proposing. In your view, is it a valid leveling of the taxpayer playing field?
I do think that from a point of view of taxation in this country, whether you're set up as a corporation or whether you're set up as not being incorporated really shouldn't make a difference from a tax fairness point of view. Why should you treat one business different than another? But at the same time, right, I'm very mindful of the fact that these tax changes will impact a lot of Canadians, a lot of middle income Canadians, and it'll impact a lot of family businesses. One of the things the Conference Board is looking at doing is investigating more about family enterprises. We don't actually have very good data on family enterprises, and I wonder to what extent we know the impact of tax changes on family enterprises when people haven't actually looked at or dissected the data. And these are some of the groups that I worry about, particularly when you have a lot of family businesses where there's going to be succession and you're going to be transferring assets from one generation to the next. As we change the tax code, we need to think about these things. The bottom line is, it would be better be doing a holistic change to the tax system as opposed to doing it piecemeal.
Good point. All right, we covered the waterfront there. Craig, thanks for joining us. Appreciate this.
Thanks, Don.
Finance Minister Bill Morneau did say the rate hike, it's being driven by a growing economy that he says is creating jobs.
We've been really clear. We want to invest in helping middle-class Canadians to feel like they're in a better situation. It's working. We've been really clear we want to invest in the long-term future of our economy. It's working. We're going to continue down that path. What we're seeing today is the results of our investments are positive, and the Bank of Canada is responding to that, which is what we would expect.
Well, in light of the uptick, it's kind of interesting to refer to a Canadian Payroll Association survey, their annual survey on Canadian worker indebtedness. It was released today, and it shows almost half of all Canadian workers would struggle to meet their monthly payments if their paycheck was delayed by just 1 week. And nearly 1 in 4 Canadian workers couldn't cough up $2,000 to cover an emergency expense. It also found that 1/3 of the workers in the survey say their debt load has increased since last year, and they're feeling overwhelmed by these obligations. And overall, only 6% of Canadians are entirely debt-free.